Hello, everyone. My name is Teresa Rickard with Jones & Roth, and I want to welcome you to today's healthcare webinar. Today, we have the privilege of hearing from our healthcare CPAs, Nicole McComber and Jeremy Prickle, about some of the key areas of the proposed tax policy changes that they are watching and that will impact healthcare practices as well as many businesses. I want to invite you to please submit your questions in the GoToWebinar control panel at any time through our presentation. We might be able to get to some of them throughout the presentation, and then we will set some time aside at the end for a Q&A. Before we get started, I'd like to thank our generous sponsor, Watkinson Laird Rubenstein, for making this presentation possible. The law firm Watkinson Laird Rubenstein provides a broad range of legal services to healthcare practices. With expert knowledge of the complex regulatory environment, their healthcare attorneys can help you navigate through the challenges of operating a healthcare practice. Thank you, Watkinson Laird Rubenstein. And I'd also just like to give a quick intro to our healthcare practice advisory team here at Jones & Roth. Our practice success plan provides value to owners and administrators throughout the year by maximizing operational and financial performance. We also support the success of practice owners, the personal success through integrated tax, retirement, and financial management planning. All right, I'd like to introduce our speakers for today. We're joined today by two of the leaders from our healthcare advisory team, Nicole McComber and Jeremy Prickle. Thank you both so much for joining us today.
Thank you, Teresa, for an awesome introduction. And thanks everyone for joining us today. We really appreciate you all taking the time out of your day to listen to our presentation. As you all are probably aware, there's a lot of anticipation around the many tax changes that are on the horizon. One of the main priorities of our healthcare advisory team is to make sure our clients and our healthcare community as a whole are aware of the important tax law changes and how they can take advantage of them within their practices. We believe this webinar format is a great way for us to share and disseminate that information and keep you all informed. And we'd love your feedback also on that. And we're hoping that you enjoy this format as well. So let's go ahead and jump into the presentation. As I mentioned, there are a lot of changes on the horizon. Originally, we had what we expected would be one $3 trillion tax bill. And that ultimately got split into two separate bills. We have the Infrastructure Investment and Jobs Act, which you see on the left-hand side there. This was originally called the Bipartisan Infrastructure Framework, or referred to as BIF, which our team laughed about because it makes us think back to the Future days, but that probably dates us a little bit. At any rate, this Infrastructure Investment and Jobs Act bill includes $1.2 trillion, of which is expected to provide $550 billion over 5 years for improving roads, bridges, mass transit, rail, airports, and waterways. It's also intended to provide over $65 billion to improve broadband infrastructure, as well as $7.5 billion to build a nationwide network of plug-in electric vehicle chargers. Interestingly, this bill is not expected to be paid for with tax increases. This bill is expected to be funded with tax enforcement of cryptocurrencies, which I thought was interesting. Also unspent COVID emergency funds, and also ultimately will increase the deficit by around $256 billion. So this bill, the current status of it is that it was passed by Congress on Friday, which is November 5th, and it is now on the president's desk to be signed, and we're really expecting that to happen any hour. It could happen during this presentation. We're kind of keeping our eyes out for when that happens. But this bill is basically on the president's desk, and it will be law very soon. The other bill on the right-hand side there, the Build Back Better bill, this is commonly referred to as Triple B or the BBB bill. This one includes $1.75 trillion to be used for early childhood care and education, fighting climate change, healthcare reform, care for the elderly, and housing. This bill is not expected to be voted on until late November. It keeps getting passed back and forth between the different parties. It will need to pass the House, then it will go to the Senate, and then likely back to the House to review changes prior to going to the president for signing and ultimately becoming law. This bill is where we expect to see the major tax changes that are going to impact all of us when it comes to tax season and beyond. The bottom line is that we probably won't know exactly where this, what's going to be in this bill in the final stages until after Christmas or right around Christmas time. I want to point out that today's presentation is intended to cover only some of the key provisions that have been proposed in the Build Back Better bill and not the infrastructure bill. There are a few caveats that I want to go over before we begin going into the meat of what's in the proposed tax bill. Because the negotiations on the tax bill are still happening and we do not yet have a law, we're in a very fluid environment. We receive updates on changes hourly with things being included and then thrown out and vice versa. And so our teams are scrambling, trying to figure out what is in this proposed bill. Today's presentation is focused on what we have researched about the bill and where we think things stand at this point in time. And nothing is final until we have a signed tax bill and the laws in place. There will likely be major changes from what we discussed today and what ultimately ends up becoming law. So you'll probably hear us say that over and over again, that you know, this is not a law yet. Please work with your healthcare advisors now and start looking at some of these things and identify the areas that are going to impact your practice. So let's go ahead and jump into the areas that we are covering or watching at this point. We're really looking at the changes on the individual tax side, the changes on the business tax side, retirement plans and IRAs, changes to the estate and trust area, as well as some other considerations that we thought we would mention. So at this point, I'm going to go ahead and hand this off to my co-presenter, Nicole. So Nicole, why don't you tell us about some of the changes we were expecting on the individual side?
Thank you, Jeremy. As Jeremy mentioned, the situation in Washington remains very fluid, so we will be watching our feeds as we present to you today. So if you're confused about what legislators are planning to include or not include, you're not alone, but we're here to help. The proposals are coming fast and furious, and so today we're just going to review some of the high-level pieces. There's not enough time to cover everything in the bill, but some key takeaways for you. But given the opportunities for further changes still to come, things that aren't in the current version could very well come back into the proposals as well. So even if we tell you something's off the table or not in on the current plan, keep your eyes out, because if there's some opposition on getting the votes they need, that's when we'll see some of those changes continue to happen. So let's start with a few of the key individual kind of headlines that most people have been following and that we feel are important to share with you today. First of all, top tax rates. This has been a hot target area. Currently, the individual ordinary and capital gain tax rate increases, apart from an AGI surtax, which we'll cover in a little bit, are currently omitted from the bill. So that might surprise some of you, because we've seen it come, it's been on the table, off the table, on the table, again, it's off the table, but keep your eyes on that. That could resurrect if other provisions in the bill are in opposition. So part of this process that they're going through right now is they're scoring the bill, and they have to make sure things are balanced. So if something's shortfall or they need more revenues, these are some target areas that we'll look at, but currently not on the table. The other big headliner that really surprised many people last week that came into the bill was raising the state and local tax, or often referred to as the SALT deduction. So in the TCJA Act for 2018, we saw at the individual level itemized deductions for your state and local taxes. So primarily your real estate taxes and your state income or sales tax were capped at $10,000. So we've had that in law for a couple years now. The current version of the bill actually added extending that SALT deduction. So it was supposed to sunset, that 10,000 cap was supposed to sunset in 2025, but they wanted to propose extending it 6 years, so it would go through 2031, but they would also raise the cap from 10,000 to 80,000, beginning in 2021. That's this year. So there might be some retroactive planning. In this case, a favorable planning for you guys to be exploring if it becomes part of the bill. And that's a big part, that's a big if. We've seen it come on and off the table multiple times. In the last 3 days, we've seen the dollar amount change. So another keep your eyes on that one. Might give you some year-end planning. You might want to look at doing fourth quarter state estimated payments in December, depending on where we land and what your personal tax situations are. The other piece is looking at, kind of some of these new surcharges that are coming on the table as we look, the SALT tax, I mentioned that's in our favor. We're not increasing the top marginal or capital gains brackets, but there is a proposal for a new tax. It's called a new surcharge tax, or an AGI tax, are some of the headlines we're seeing behind that one. This one's hitting some higher income levels. So it's not, on the surface, it sounds like it's gonna hit everyone, but it's not. Currently in the proposal, it's a 5% surtax for AGI that exceeds 10 million, or if it's AGI in a estate or trust, it's 200,000. So very different income thresholds to be using there for planning. And there's some additional tax if you're over 25 million. The threshold is for these, there's not a difference in the threshold for joint filers versus single filers. So looking at your filing status, but there are some provisions if it's married filing separate. Ultimately, this AGI surtax, what it would be accomplishing is it would be bringing the true top proposed tax rate to a 45% ordinary income tax before any of the Medicare or net investment tax, and a 28% capital gains tax. So that's why we saw those top rates taken off the table, because they essentially substituted it with this new tax for those high income limits. Those thresholds can change, and we might see that evolve, but that's where we stand today on where we're at with the tax rates. The other tax that's been around for a little while, but they're looking to expand it, is the 3.8% net investment income tax. So that's a tax that typically people think, oh, it's on my passive or investment activities if I'm a high income earner. Really what the bill's looking to propose is expand the scope of that. So essentially all income that's not subject to employment, so not your W-2 income, but all pass-through income, if your income levels are high enough, would be subject to the 3.8%, not just income that you are passive in. So those of you that are private practice owners, putting you over the income limits, some of the income levels we're seeing is either 400,000 for a single filer or 500,000 for a joint. Again, subject to change until we see a final bill there and where they land. But that could substantially increase how much of that tax is going to hit the bottom line. That tax rate is looking going forward from 2022 tax years through 2031 tax years. So not a concern for 2021, but definitely some planning and things to think about for next year if that comes in the final bill. And then the last thing, Jeremy hit on it early on, some of how they're paying for these is in the virtual currency. So on the individual tax, we've seen attention to this already. The last couple of years, we've seen different renditions of questions on individual taxes on whether or not you've purchased, sold, or invested in virtual currency, digital assets, cryptocurrency. So now they're looking to enforce more reporting to try to get more visibility, because the government really feels this is an area that maybe not everybody's reporting all the income. And so they're really searching in these bills for their revenue raisers on where are buckets that maybe are at-risk areas that they haven't had visibility because there haven't been 1099 reporting requirements. So the big thing there is make sure if this is an area that you are tracking your pieces, your basis and your sales and your transactions in those correctly. But no, they're trying to get more visibility to it. So that certainly can kind of change our perspectives as we look at kind of these top individual tax areas as we navigate not only this year, but the future years to come. So Jeremy, I'm going to hand it back to you to take it here from some business considerations we have.
Okay, thanks, Nicole. Okay, so on the corporate tax side, one of the things that's been batted around a lot within these proposed bills has been to increase taxes at the C Corp level. And so the first thing that's been batted around is moving us back to a graduated tax system for C corporations. Currently, we have a flat tax rate for C corporations of 21%. So no matter what your taxable income is, it's taxed at 21%. Previous to the 21% flat tax, there was a graduated system in place. The original proposal that we've been looking at was basically moving us back to a graduated tax system where your income up to $400,000 would be taxed at 18%. Anything above $400,000 and below $5 million would be taxed at 21%. And then anything above $5 million would be taxed at 26.5%. This change or this proposed change has basically been omitted from the latest proposal, which means at this point, we're still left with a 21% flat tax for C corporations. The other thing, though, that they've added, while they've decided not to change the corporate income tax rate, they have decided to add an alternative minimum tax, and this would be only for C corporations and only affect as a very small number of companies. In fact, lawmakers claim it should only affect about 200 companies. Essentially, it would add a 15% minimum tax on corporations that report a 3-year average annual adjusted financial statement income in excess of $1 billion. So I'm going to make the broad assumption that nobody on this call is in this category. So it's probably not worth going into too much detail in this area. For what it's worth, the effective tax years for that alternative minimum tax change would be after 12/31/2022. If you'd want additional details and somehow you are affected by that, please give us a call. We'd be happy to help you with that. On the next one is the new interest deduction limit. This would create a new limit on the deduction of interest expense mainly it would only affect domestic corporations that are members of multinational groups. It would limit your business interest expense over 12 million over the past 3 years, and it would essentially disallow interest being carried forward indefinitely. Again, this is one that's probably not going to be probably most of us on this call aren't going to be impacted on this. The effective date for this is going to be after 2022. The next one there is the limit on the 20% qualified business income deduction. As many of you may be aware or have been impacted by, there's a current law in place that was passed in 2018 that allows pass-through business owners to take a deduction of 20% of the business income being passed through. And so this is for S corporations, partnerships, sole proprietors, those types of entities. This original law provides a phase-out limitation for what we call specified services trader businesses, or we refer to them as SSTBs. And that mainly impacts our medical practices. So not very many of our doctor clients have been able to take this benefit anyway because this had a previous limitation. So the proposal on the table prior to basically Friday was that they were going to add this limitation to non-specified services trade or business. So essentially your real estate activities, any other types of non-specified services trade or business would be limited by this as well. The good news on that is that the proposed bill that is in place at this moment does not have anything with respect to the additional limitation on this. So it does still have the limitation for the specified services trade or business, but it does not have an additional limitation which we thought was going to be in place originally. Okay, the next one is the excess business loss limitation. This is another law that was passed in previous legislation, but has been suspended due to the coronavirus through 2020. And it was originally set to expire in 2026. Essentially what this would do is limit the ability for businesses to deduct losses that are incurred in a pass-through business, again, a S corporation, LLC, partnership, and essentially it would limit the ability to deduct a loss. So if you had, let's say, $1 million loss and you wanted to use that against previous income and apply for a refund, they would not allow you to do that, or they would limit it. Currently, the limitation that's in the proposal is that it would be a $500,000 limitation for married taxpayers and a $250,000 limitation for all other taxpayers. The other thing that's in this is that net operating losses would not be allowed to be carried back. Again, that was in the original bill, but got suspended. And then the other thing that they're proposing is that instead of this expiring, what they thought was going to expire in 2026, they are planning on making this to be a permanent change, which would mean there would be no sunset provision where it would expire. So this is something we're not happy about, because obviously when businesses have losses, they like to deduct those losses, and any limitation of that can cause some angst. So the next one here is the early termination of the employee retention tax credit. I'm sure a lot of you have heard about the employee retention credit. It's something that came about last year during the COVID-19 pandemic. Originally, it was people that had received the PPP loan were not eligible to apply for the employee retention credit, which allows you to take a tax credit for keeping employees working for you during tough times. And then they since changed that, and they said even if you did have a PPP loan, you could still apply for the employee retention credit. This proposal, the proposal in place right now, would eliminate the credit after September 30th of 2021, which means that you basically would not be eligible for it. So just a warning there on the employee retention tax credit.
Yeah. And Jeremy, I might add there that employee retention credit, there is an option that's been in place with those where you could reduce your tax payments as you went rather than waiting for a refund on the back end. So very critical if you were employing that for fourth quarter, because fourth quarter started October 1st. We're almost a month and a half in. There's some catch-up payments that probably are going to need to happen, and we're working with our national associations to try to get some relief of, are they going to waive penalties? What are they going to do with that, given this bill coming forward? But certainly if you kind of did the reduced tax payments because of that, thinking you still qualified, call to action for those individuals and businesses.
Yeah, great point, Nicole. Thanks for chiming in on that. The next one here is the paid family and sick leave. Certain employers under previous law would receive a tax credit for providing paid family and medical leave to their employees. And this is something that's been in place for a while. The proposed law that's in place right now would essentially terminate that credit that's allowed for employers that are providing that benefit. Originally, this law was set to sunset or expire in 2025. So what they're doing is basically eliminating that credit. And then, this is good news, there would be a proposal that would allow eligible workers who do not otherwise receive a paid leave at work to qualify for up to 4 weeks of paid parental, sick, or caregiving leave. And this would be paid entirely by the government, not the employer. And that would be expected to start in 2024. The other side benefit to this is that any of the benefit that you would receive under this plan would not be included in your taxable income. Our expectation, just from a planning perspective, is that a lot of employers will probably stop providing paid family and medical leave and may consider reducing or removing those benefits because the federal benefit will essentially take over. So definitely some things to watch on the business tax side. Now I'll touch on some of the retirement plan and IRA changes. This has been a hotly debated topic and lots of back and forth with respect to the different proposals that we've been looking at. The latest proposal mainly affects taxpayers whose income exceed $450,000 if you're married, or $400,000 if you're single. What it would do if you're over those limitations or over those income caps is it would bar you from making any contributions to an IRA once your aggregate retirement accounts reach $10 million in value. And this would start in 2028, which is good news because it was originally scheduled to go into effect in 2022, which would be a really fast change for something this dramatic. The other thing this would do is require taxpayers with aggregate retirement accounts exceeding 10 million to start taking funds out. And so it would be called a required minimum distribution requirement. Currently, there's a required minimum distribution requirement, but it's not until age 72. This would require, if you were over those income limits, you would have to start taking out your retirement funds early if you had balances over 10 million. Again, this goes into effect in 2028. Originally, it was slated to go into 2022, so we're happy that that got moved back. The other thing that it would do, again, for people that are over those income limits, would bar any rollovers from a traditional IRA to a Roth IRA beginning in 2032. So basically eliminating those Roth conversions that many of us like to take advantage of. Again, the previous proposals were much more restrictive with a bunch of limitations happening at the lower income levels. And so we are watching this and hoping they don't bring some of those originally proposed provisions back. This is another area that we're not fans of because obviously it affects how much you can save for retirement. And we think that's a good thing. So just as a planning point, something you might want to share with your doctors in your practices or yourselves, what we're doing is advising our doctors to, if you're wanting to do any Roth contributions, IRA contributions, or Roth conversions, get those done while you still can, because again, most of these changes don't happen until 2028. The other thing that I thought I'd mention here is just the 2022 retirement plan contribution limits have been increased. They're slated to be increased. The 401k deferral limits are planned to increase from 19,500 to 20,500. The simple contribution limit has been increased from 13,500 to 14,000. The annual IRA contribution remains unchanged at $6,000. Your catch-up contribution limit for the 401k accounts and 403bs for people that are 50 and older, that remains unchanged at $6,500. So if you are contributing to a 401k and you're over age 50, the combination between the deferral limit of $20,500 and the $6,500 catch-up would allow you to contribute $27,000. And then on the simple, the catch up for that also remains unchanged at $3,000 if you're over 50. Okay, so lots of changes there. Nicole, I'm going to kick this back to you to go over some of the changes expected on the estate and trust side of things.
Thank you, Jeremy. So as you see, a lot of different buckets that we're working through. On the estate and trust, there's been a lot of tug of war going on here, and specifically as we speak, as we know today, the following proposals from prior versions of the bill are no longer included. So you're looking at, there's no reduction in the state tax exemption from the current 11.7 million to 3.5 million with adjustments for inflation. So that's off the table at this point. There are no limitations on the use of grantor trust in the current version. There's also the stepped up basis for appreciated assets and estates is remaining untouched at this point. And then finally, there's no change on the use of discounts in the estate and gift tax valuation of non-business assets. So you might be thinking, that sounds like all great news. Although they're not included in the current draft, these will stay on the watch list. It is quite possible that these will resurface, if not in this bill, future bills next year is kind of the noise we're hearing. They're trying to get one bill done. This seems to be an area with a lot of contention, but not an area that they're willing to leave untouched entirely. So I would definitely keep it on your watch list as we navigate and work through the bills that they're working through now and bills yet to come in the coming year. We could see something as early as January starting to brew up back on this surface. There's also been noise of if the retirement plan stuff doesn't get accomplished, that's where they would bring it back up to in a future bill as well. So keep your eyes out. Good news so far. Does probably change or impact some of the year-end planning people have done, but we don't expect to see our estate exemption levels and some of these provisions to stay in place for very much longer. It's just time will tell. So it leaves you scratching your head. So we'll step into.
We had a question come in, Nicole. I thought I might just jump in here since it's about the retirement slide that we were just on. The question is, did you intend to say that the catch-up age is 50 and older versus older than 50? Wanting to clarify.
Yes,
Let's see.
So once you reach age 50, you are eligible for the catch-up contribution amount.
So as soon as you turn age 50.
Correct.
Okay.
Sorry if I confused anybody by that.
Great, thank you.
Perfect. All right. So some other considerations as we kind of work through these, as if all the federal changes weren't enough, we've seen a lot of activity at the state levels across all states. In reality, everybody's sharpening their pencil, trying to adjust their budgets, looking for new tax dollars. So some of the state tax rate changes we're seeing. So for example, Oregon, we've seen an imposed tax rate change that was passed this summer that went retroactive to beginning of this year. So effective 1/1 of 21 on the pass-through entity tax rates, often referred to as the PTE tax rates. So the changes that happened there is they have the bill that was passed in the summer is now there's a reduced personal income tax rate for pass-through entities that has imposed two different marginal tax rates. So depending on what your marginal income is, what your adjusted gross income numbers are, that will drive whether or not you're fully phased out or partially phased out. Some people might see a little more benefit, others could see it completely eliminated. So really important, since that's effective for 2021, go back and run your numbers. This could mean even if your taxable income is exactly the same as it was last year, that you could see a tax rate or tax bill increase simply by this pass-through tax rate change that's happened. There's also some more requirements on qualifying employees per owner, whereas before it was just you had to have at least one qualifying owner. So in addition to those, they're looking at some other conditions. So I would definitely sharpen the pencil, look at these, make sure you're running those through when you're working with your advisors for fourth quarter to see if you need to make any adjustments to make sure that you are penalty proof or are slated to be where you need to be for taxes at the state level. On the plus side for Oregon, however, we are seeing a historic high Oregon kicker refund in addition on our 2021 taxes, which is going to be based off of your 2020 Oregon tax liability. The kicker tax refund rate is 17.341% of your 2020 tax. If you have taxes from other states, there's some coordination of what that formula is. But that's a pretty substantial number and could change maybe what you're doing for fourth quarter as well, now that we know what that percentage is, as it'll be a credit on your Oregon taxes and will reduce any tax that would be due. And if you've overpaid, it's a refundable credit. So we definitely recommend updating, looking at your income tax estimates as you're doing your year-end planning for the state and local changes, as well as some of the federal stuff that we're looking at. Another big state change that to kind of give you a flavor of what's going on, Washington State has also passed a new capital gains tax rate. It's effective for January 1, 2022, but earlier this year, Washington passed a 7% tax on sales or exchange of long-term capital assets, such as like your stocks, your bonds, or other investments, and tangible assets if your profits exceeded $250,000 annually. So big piece to look at there. That's a new one on the table. We're not used to seeing an income type tax in the state of Washington, but gives you a flavor. We're seeing these types of movements across all state and local platforms, that we can't just kind of rely on good old Sally, same as last year, on what your tax rates were. So some planning points as we work through there. The other one, which may or may not be as pertinent depending on where we land with this Reconciliation Act bill that's being worked through, is we've seen several states implementing SALT limitation workarounds. So we talked earlier that SALT is that state and local tax deduction on your individual taxes. And so what we're seeing are states implementing ways for you to pay state taxes on your business income at the business level and get a business deduction for it. So it's not landing on your individual return as an itemized deduction. So again, depending where we land with the federal bill, this may or may not be an election that you would want to utilize, but it's definitely a tool to pay attention to. For example, when we look at California passed a state and local workaround tax workaround there, their tax bill passed it, so that's effective for this tax year, 2021. So as we look at those, it's an elective pass-through tax rate, but it's an irrevocable election. So on the California platform, if you have California business income and tax you're paying, a couple of things to be cautious of there is, do you want to pay it at the business level? Do you need to pay it? And if it's taken as this credit, because what would happen is you deduct the state taxes at the business level, but then you get a credit that you report on your state income tax return to offset your state tax. However, we have to remember California has an alternative minimum tax, and the credit itself is not refundable. So if it's overpaid, it rolls forward and it's up to a 5-year carry forward. Looking at what marginal tax bracket you're in is another factor that you'd want to look at, because it's a credit paid based off of the max tax rate. So caution and planning is important as you navigate through those, not only because it's irrevocable, but also because some of those other indirect tax impacts of taking a credit instead of the tax paid at the individual level. Oregon similarly passed a bill this year for a SALT workaround. The difference here is Oregon's tax bill is effective for 2022. The election is applicable for tax years starting next year, and they wrote it for that it would be in place through the end of 2024. So a little more finite window that we're working with. But the main thing that they were looking at in this bill on the Oregon forefront is there's actually a provision in it that says there's a repeal of this pass-through credit if the SALT cap gets repealed at the federal level. So depending on what happens, right now we're not going to have it eliminated, but whether or not you need to take that election in order to get those deductions back on your business income is really going to depend on where your federal deductions are, and looking at as a group, some of these bills at the state levels, everyone has to opt in. Other ones only you can do on a one-by-one. So be looking at those really carefully. There's not an automatic yes or no when you're looking at a SALT workaround, especially when the federal government hasn't made up their mind on where they're going to land on the SALT cap. So more to come on that. Don't ignore it. Be watching it carefully and be attentive on, do you need to change anything next year if you're going to be paying that tax at the business level rather than estimated tax payments on your personal tax. Another large area that's been buried in these bills and has caught a lot of attention and should catch a lot of attention is there's pretty significant IRS audit funding that's been added as part of these bills that's in the proposal. The federal proposal would provide funds to the IRS for taxpayer service of $2 billion, enforcement of $45 billion, operational support of $27 billion, and a business system modernization of $5 billion. Not small numbers, and that should kind of catch your attention of they're really looking at enforcement and service and how they can really look at the data and catch who's not paying their taxes appropriately. There's a strong feeling that people either don't know the rules, our taxes are complex. So making sure you get proper advice and are getting things documented and supported in your records effectively. We've worked with several audits where you can have a no change, but it's making sure you know what you're doing and that you have the support and documentation, because we're expecting their focus area here isn't on high income earners, is where they're really going to ramp up audit activity. High income's been kind of thrown around. We've seen anywhere from 400,000 to 500,000 as our threshold. So that's going to hit many of the individual tax payers at the physician level of the practice owners. And when you get audited at the individual level, it typically rolls up to the practice level as well. So just making sure we have our house in order on that one, and know that an audit's not necessarily a scary or bad thing. You just have to be prepared for it and have everything, your house in order. Teresa, any questions that have come in at this point before I
no, and I was going to suggest that we use some of the Q&A time just to encourage everyone to submit any question that they might have, even if it's an unformed idea at this point. But also, Jeremy and Nicole, have you been hearing any questions from your clients that might be useful for others? So those were just some ideas that I had.
Yeah, I mean, and I'll hand off to Jeremy on a question here, but we've hit on a lot of things to consider, but there's also a lot of other typical and tax planning tools and techniques that are really important to leverage and utilize as you're approaching this month and next month as winding down the tax year. So there's various tools, working closely, asking questions. We know there's change, but there's also best practices of items and things that kind of pull into play. Jeremy, do you want to share a little bit on some of the disaster, qualified disaster relief payments?
Sure. So one of the things that has been a huge question is, how do I take advantage of some of the tax laws that are in place? And one strategy that we've seen used to some success is there is a code section called Code Section 139, which allows businesses to pay their employees for assistance with respect to a federally qualified disaster. And now this has been something that's been in the law for a long time, but is really relevant right now since we're in a pandemic. All of us are in a federally qualified disaster zone, basically, because the pandemic is a federally qualified disaster. So what the tax law says is that businesses can pay their employees. Keep in mind, this does not include the owners of the business, but the employees themselves. It will allow a business owner to pay their employees to assist them with anything that they have related to the pandemic. So it might be additional childcare. It might be assistance with schooling or tutoring. It might be additional cleaning supplies. It might be a work from home arrangement. any of those kinds of things can really help those employees along. The cool thing about Section 139 is it doesn't require you to keep records of what the employee spent. So essentially, you can give them this benefit. And again, we don't recommend that you get too overly aggressive with the amount. I would say Nicole probably has a different threshold than I have, but I would say probably somewhere between $1,500 to $2,000 or $3,000 is probably the maximum I would recommend you go in this area. But essentially, it allows you to provide a tax-free benefit to your employees that's not taxable to them. It's not subject to payroll taxes, and is a beautiful thing when it works out. The other thing you want to be careful about with respect to Code Section 139 is you want to be careful that you don't discriminate. And what I mean by discriminate is you don't want to give the benefit only to your employees that have been there for 10 years, but not to the employees that have been there for a year and a half, because they've all likely incurred the same expense, which you're trying to provide a benefit for. So just be careful about how you incorporate that change if you decide to do that. But it is a great way to get some tax-free money to your employees, and also avoid paying payroll taxes from the employer standpoint.
The other big hot topic, one that we've had a lot of questions on, is the employer retention tax credit. I know we hit on that it was sunsetting, but there's still opportunities. A lot of people didn't know how to take advantage of it and how to go about. You can amend for prior quarterlies if you qualified to try to get some of those dollars back. The biggest piece that I kind of caution people and work through there is those amendments do take time for the government to process. So we've seen ones in the queue that we're looking at 8 to 10 months before they're seeing the refunds, but it is cash and credits that are available to you that if you haven't gone through those exercises, the rules change significantly in 2021 for those credits. That if you haven't looked at those, definitely an area that I would recommend making sure you've had the opportunity to take advantage if it was there.
Well, that's great. I think what's probably going to happen is a lot of our folks who are watching live today, as well as those who watch the recorded version of this presentation, will most likely be meeting with their advisors to talk about details, and that's exactly what we're hoping for. I do see another question that just came in regarding the Oregon the CAT tax. Physicians cannot pass along the cost to healthcare consumers due to fixed fee schedules. Is there any chance of changes to the CAT as far as you know?
So there have been a lot of bills and different legislative plans that have come out of the CAT, but nothing of those address that. It's been a pretty hot topic area because hospitals aren't subject to it. And so practices look at, well, how is my surgery center different? How are the practices, because you don't have the discretion to just increase your margins to cover that. It's a tax that we don't see going away right now, and we haven't seen a whole lot of favorable movements around that consideration. Definitely pushing on it. There's definitely been a lot of questions around it, especially because there's certain sectors that have had some exclusions or preferences that aren't applying to the entire industry. So definitely an area to keep an eye on there. Also do encourage to make sure, that on the calculations there that you're utilizing and capturing all the expenses that are applicable to help offset. But that one's been a hard hit to the bottom line, period. So, but as we close today, I think the biggest thing we want to remind you guys is that all of these provisions that we've talked about today on the federal platform are still subject to change. So nothing's final until we get that final signed tax bill. But we certainly don't want you guys to wait till we have a final bill to start your planning, because your time is limited. So it's important to be working with your healthcare advisors as you navigate through year end and prepare for the changes to come.
Awesome. Jeremy and Nicole, thank you both for sharing your expertise with us. I'm going to go to the slide with your contact info. So if you would like to get in touch with us, you can reach Nicole and Jeremy at their email or through our website, jrcpa.com/news for our blog, and you can click on our healthcare page to learn more about our healthcare advisory team. We really hope that you received some good information today, have a better sense of some of the key areas to be looking at as we approach year end, and we will make our best effort to be posting updates as we receive new information. So check the website, and we will be updating you. Thanks again, everybody. Have a great afternoon.